Okay, let's get started. Welcome, everyone. So my name is Brooke. I am one of the account managers here. Just want to welcome you to our ACA training. Thank you for joining us. Laurie Keller will be presenting today for our second webinar on the Affordable Care Act. So I'm going to go ahead and just turn the time over to her.
Thanks, Brooke. We're excited to have you all here today. We're glad to be giving these webinars. We're really excited. This is something we've been really hoping to do for quite a while, and we're glad that we now have the chance to, even though we're not under ideal circumstances. Before we begin, I do want to show that you do have in your handouts section a lovely ACA Basics Quick Guide. It just has a simple summary of the ACA and things you should know. It just ends up being a quick reference guide that you can use outside of this presentation. These webinars are being recorded and they will be available online shortly. We're waiting to get a few more recordings underneath our belt so that we make sure that they are all nice and tidy before we upload them. So we'll show you at the end of this webinar where those will be and where they will be available. We're excited for this. We do want to add the caveat that this is not legal or tax advice. However, we do have excellent resources at Beehive that we can refer you to for specific advice, whether that's legal, tax, HR specific. We have some excellent resources. So please feel free to ask your questions in the comments section so that we can reach out to you or we can answer them during this webinar. For those of you who were with us on our first webinar on Tuesday, if you weren't there, it will be available online shortly, but also we want to do a similar recap that we did on that first webinar. So in case you missed it, or if you were a little late coming in, the simple statement of the employer mandate, what employers need to know regarding the ACA is that large companies have to offer quality coverage that is affordable to 95% or more of their eligible employees or pay a penalty. And as you remember, each one of those terms has a very specific definition. Our previous webinar on Tuesday, we did go over who is large or an applicable large employer. So feel free to go refer back to that when you are ready. I paused showing my screen. I'm sorry about that. We're still learning how to do all of this. We're really excited for you to be patient with us. So for those of again who missed it, here's our employer mandate summary. So this is the summary of the employer mandate, and today we're going to go over who is an eligible employee. Now, simply, those are employees who average 30 or more hours per week, but as we all know, sometimes employees work more or less, and it ends up being quite difficult, especially for our employees who are part-time or their hours change. So this is one of the more complicated topics that we're going to be going over today. So please, if you have any questions, if you have specific situations that you're curious about, ask those in the comments section. We are excited to help you with any of those questions. So as we continue, we do want to go over a few acronyms again, just as we did in our first webinar. The first is, of course, the ACA or Affordable Care Act. In this webinar, we will also be using FT for full-time or full-time employee, and PT for part-time or part-time employee. So really easy acronyms to be using this webinar. Before we go over who is an eligible employee, we first have to answer who is an employee. And it's simply anyone who receives a W-2. So if you have anyone who is receiving a W-2, they are considered an employee, and you need to consider whether or not they need to be offered benefits. So start with that as your definition of employee, as anyone who receives a W-2. So who is not an employee? People who are not an employee are people who may be a 1099 contractor. And make sure when you are designating somebody as a 1099 contractor that you are doing that appropriately, just so that you're not inappropriately misclassifying somebody as 1099 when they should be W-2. So 1099 contractors, owners who aren't receiving a W-2 are technically not an employee. Partners in a partnership, sole proprietors, and volunteers are also not technically employees. So we are going to be considering anyone who receives a W-2 as an employee, and we need to consider whether or not they are eligible for benefits. So now let's look at who is eligible. The simple way of looking at eligible is an employee who is hired with a reasonable expectation of full-time work. Throughout this webinar, we're going to consider them ducks. They are people who act like a duck and look like a duck, so they are expected to be treated like a duck. So anybody you hire with that expectation and they start out that way, please treat them as full-time. The ACA, however, also defines full-time eligible as 130 or more hours per month. If you multiply that out throughout the year and then divide by the number of weeks, that ends up being 30 or more hours per week. So if you are only offering benefits to people who work 40 hours per week, you need to also be considering offering benefits to people who work 30 hours per week. We also need to remember that an hour is any time that an employee is entitled to pay. So when you are adding up an employee's hours, please do include paid time off, paid sick leave, jury duty, and more. If you have an unusual pay type, such as per piece or per mile or some other type of pay rate, the IRS does have specific guidelines of adjunct faculty and for airline employees that we can use to determine how you are supposed to count hours. You do need to use a method of counting hours that is reasonable and consistent. So if you have an unusual pay type, please reach out to your account manager so we can figure out exactly how to count your employees' hours to determine full-time eligibility. So again, as we're going through this, remember, if it looks like a duck and quacks like a duck, it's a duck. So if you have employees who are looking like they're working full-time and they are acting like they are working full-time, please treat them as full-time eligible from the start. So those are people who are eligible. Just treat them as full-time eligible from the start, and that'll make it a lot easier for you and all of your employees.
Laurie?
Yes.
Quick question. So in the last webinar, we said that full-time was 120 hours, and this time we're saying it's 130. Do you want to address that real quick?
Yes. So the last time we were talking not about full-time eligibility, but full-time equivalence. So when you are discussing and figuring out whether or not you are an applicable large employer, you need to consider how many full-time equivalents you have. And a full-time equivalent is somebody who works 120 hours per month. A full-time equivalent employee does not necessarily have to be offered benefits. I wish the IRS and the ACA used the same number for full-time eligible and full-time equivalent, but they didn't because the IRS does not like to make things easy for any of us. So we are looking at now full-time eligible, which is a different number. Does that help? I hope.
Yeah, just know that it's weird that they're different. We recognize we're using different numbers, one for counting whether you're a large employer and then a different number on determining if benefits are offered.
So if you have any questions as you are going through your own employees or figuring out your own whether or not you're a large employer or an employee's eligibility status, please feel free to reach out or ask us specific questions about what's going on. We would love to help. But for the essentially the rest of this webinar, we're going to keep that 130 hours per month or 30 hours per week in mind. So I know it ends up being confusing, and I really do wish they would have used the same number, but it is 130 hours per month for the purposes of determining eligibility. So now that we know an eligible employee is somebody who averages as somebody who works 30 or more hours per week or 130 hours per month, we need to look at who is ineligible. So ineligible employees are employees who never work more than 130 hours per month. We can consider these people part-time. But that never is really, really hard. So what about everyone else? Because we all know that we have employees who sometimes work less than 130 hours or less than 30 hours per week, but sometimes maybe there's a rough week or lots of work to do and they work more than 30 hours per week. So a person who might work more or less than 130 hours per month is variable hour. So keep in mind that these ineligible employees and these variable hour employees are not ducks. And we're going to be looking at these ducks in these next few examples. So we're going to be looking at the not ducks for these next few examples. So for variable hour employees, there are two methods of determining if they are eligible for benefits, because they may be eligible, they may be ineligible, depending on what their hours end up being. The first method is the monthly measurement method. It uses current hours to determine current eligibility. The other and more common method is the look-back method, and it uses historic hours to determine current and future eligibility. So first, we're going to go over, so these are for our variable hour employees. Again, if you have an employee who looks like a duck and quacks like a duck, treat them like a duck. These are for our employees where we don't know yet. So for our monthly measurement method, it simply is, if someone works 130 hours in a month, they are eligible during that month. If they work less than 130 hours in a month, they are ineligible for benefits during that month. So this one ends up being fairly clear cut to understand. Implementation is a little bit different. So let's look at a quick example for the monthly measurement method. So we have some teachers. We love our teachers, we're really excited, but we also have substitute teachers. So Jamie is a substitute teacher who normally works 80 hours per month, definitely part-time. However, another teacher goes on FMLA in September, October, and November. During these months, Jamie works 175 hours each month to cover the other teacher's classroom. So now that 175 is more than the 130 required to be an eligible employee. If we are using the monthly measurement method, then Jamie is eligible for benefits during September, October, and November. You do want to keep in mind, though, if you do offer benefits to Jamie during these months, Jamie may be ineligible for subsidies on the ACA marketplace. But if you are using the monthly measurement method, then Jamie is eligible. So the other method is the look-back method. This method very literally looks back on a set period of time to determine an employee's eligibility. We can represent this by this chart or table. We will be going in depth, but first let's look at the terms that are labeled on this table. You can see we have dates over quite a few years, and then we also have some different periods labeled on the left. So the first period that we're going to look at is the measurement period. This is the period when hours are measured. It is usually 11 to 12 months, but it can be shorter. It is generally better for it to be 11 to 12 months. That is what Employee Navigator supports. The measurement period is followed by the administrative period. This is when the employer completes the administrative tasks that are necessary to offer benefits to eligible employees. It is usually 1 to 2 months, depending on how long your measurement period is. And then lastly, we have the stability period. This is the period where an employee is treated as eligible or ineligible based on their hours they worked in the measurement period. It is usually the same length as the measurement period. It can be longer than the measurement period. It cannot be shorter than the measurement period. As you can see on our table, we have color-coded each set of periods. So the blue administrative period corresponds to the blue measurement period. and the blue stability period corresponds with the blue administrative and measurement periods. So we have color-coded those as time goes on, and you can see that there are times when an employee is in a one measurement period, a different administrative period, and a different stability period. So it ends up being a little complicated to look at, but we'll go through an example so that we can outline how this works in a real-life situation. So here's our look-back example. Now remember, employees who work an average of 130 hours per month during their measurement period are eligible. Over a 12-month span, that would be 1,560 hours or more. So we're going to look at John. John works mostly part-time in an unspecified industry. Occasionally, they work more hours when there's a big construction job, lots of weddings to cater, or whenever he is needed. When he is hired, John's employer doesn't know if he will work enough hours to be considered full-time. So John does not initially look or act like a duck. He is variable hour, so his hours are going to be tracked using the look-back method. So now let's look at John's hours and how they correspond on this chart. We're going to start during the blue measurement period, where John works 1,860 hours. This means he is eligible for benefits during the corresponding blue stability period because the number of hours he worked is more than the 130 hours required per month. As you can see, the 1,860 hours is about 155 hours per month. So, as following our example, during the blue measurement period, we look at his hours. And during November and December of each year, John's employer, right here, is going to be looking back at each employee's hours to determine if they are eligible. Based on John's hours in this measurement period, we're going to look at his hours during this time in November and December, and John is going to be eligible for this entire stability period. So now John is eligible during the entire blue stability period, but during the orange measurement period at the top, John only works 1,260 hours. This means he is not eligible for benefits during the orange stability period. And John's employer will continue monitoring John's hours to see if he'll be eligible during the green stability period in 2022. So even though in the orange measurement period at the top, John is working less than 130 hours per month, John is eligible during the entire blue stability period until the end of December 2020. This is an area that ends up being kind of confusing and complicated because we look at John and we say, well, he went part-time in March and now he's only working 80 hours per month, but he's eligible during the entire blue stability period. One common question we do get is with employees who move from full-time to part-time. Now, because they have moved from being a duck to no longer being a duck, they are now a variable hour employee, and you need to look at their hours. So you may have an employee who was hired in, say, October of 2018, and you initially began to offer them benefits because they were a duck, but somewhere in 2020, they end up moving to part-time. Because of the look-back method, they will need to be offered benefits through the end of 2020, or they need to be eligible for benefits through the end of 2020 because of the previous hours they have worked, even though they may be part-time. However, the employee who has moved to part-time can choose to drop their benefits anyway because they have experienced a qualifying life event, such as a significant decrease in pay. So this is one of the areas that we have found that we do try and reach out when we encounter it before we drop certain benefits for employees, because we want to make sure that you are in compliance as much as possible to ensure that you are offering benefits and are avoiding any possible penalties. So looking back on an employee's hours ends up being a little bit confusing, but it is important to recognize that John will be eligible for benefits through the end of 2020 based on his previous hours worked. But again, an employee can obviously choose to drop benefits, but you dropping their benefits as an employer or an HR manager is not something we like to have you do because it's not the employee's choice and you are withdrawing the offer of benefits when you choose to do that. So having the employee go into the system and do that on their own is the ideal situation. Keep in mind that your periods may be different lengths or may start or end in different months. It is the best practice to have your stability period line up with your plan year. So if you have a plan year that goes from January to December, then this is an ideal example for you. But if your plan year goes from June to May, you would want to offset this chart a few months until the stability period matched up with your plan year. So there are some pros and cons with the different methods. The monthly measurement method is good for one-time bumps that are generally predictable. So in the example of our teacher who was going on FMLA, you as an employer, you might have some warning or some heads up, and you can know and be prepared to offer benefits in that situation. However, the monthly measurement method is not supported by Employee Navigator.
Sorry.
Yes.
Sorry, a quick question on the monthly measurement method. So how does that work when an employee works 130 hours in one month and then the next month they don't and they flip back and forth? And then when is that offer supposed to occur? I mean, at the beginning of the month, you don't know that they're going to work 130 hours.
Yes, that's what makes the monthly measurement method difficult. And that's why it's better for one-time bumps that you can kind of predict. In that case of an employee working, say, 130 hours in February, but not working 130 hours in March, you would need to offer them benefits in February, but not in March. And then if they begin working more hours in April, that's another offer of benefits. So it can be up and down using the monthly measurement method, which is also part of the reason it's not supported by Employee Navigator. And that's why I suggest it primarily for one-time predictable bumps where you have very predictable hours across all of your employees. That's why the look-back method is the more common method, because in that situation of the teacher who is working 80 hours per month generally, but works 175 hours during those 3 months, if we add up their hours, that would be, let's pull up a calculator first. So here's our calculator, and let's go back to our teacher slide really quick. All right, so here's our teacher, and here's our calculator. So they are working 80 hours per month for 9 months of the year. And that's 720 plus the 175 hours for 3 months. So using the monthly measurement method, we would have to offer them benefits during those 3 months. But if we were using the look back method, because the employee initially doesn't look or act like a duck, we wouldn't be offering them benefits until the next stability period because they worked. So if we average this for our whole year, that means during the whole year they worked 223 hours. So in the stability period is when we would have to offer them benefits. We wouldn't have to offer them benefits in September, October, and November. It would be beginning later in the next year. And this would also mean that you wouldn't, if you were offering benefits, as soon as this employee was eligible, you wouldn't have to worry about their subsidy being affected, and they would be just fine during those months where they're covering for the full-time teacher. So,
Laurie?
Yes.
Actually, in that example, they work 1,245 hours over the 12-month period, so they wouldn't be eligible for benefits.
Did my calculator do the math wrong?
I think it was entered a little wrong. Okay. So because they didn't work over 130 hours, then they're not actually eligible for benefits at all under the look back method. So that's kind of what you can use to help determine which method would be best for your company, is by looking at your employees to decide, what are you trying to do? Are you trying to offer benefits when this happens, or are you trying to not offer benefits when this happens? We did have another question. If an employee moves from a full-time position where they are a duck, but they move from full-time to part-time and decline benefits because they believe they're eligible for other coverage, then they find out they're not, but they're working part-time. How does that work? Do they need to offer benefits again? Does that current offer just continue?
So the only time an employee can change their election is with a qualifying life event. And so when they choose to drop benefits, so they chose to decline their benefits because they went to part-time, it does end up being a little bit complicated. So them finding out that they may not have a subsidy, we may be able to re-enroll or reinstate their benefits, but that is going to depend on the timing. Certain carriers will only allow us to go back so far with enrolling in benefits, and it ends up, again, it's not an ideal situation.
Right, so because the offer continues, the life event is because they went to part-time, but the offer of coverage continued. So unless they had another life event to add coverage, then they wouldn't be able to add, because it's not that your offer of coverage started again, it just continued. So a life event would allow them to add again. So they just need to be careful that they don't drop because of part-time, but they drop because their coverage began, and then that would prevent them from having a lapse in coverage.
Yep. So let's we'll talk through a quick example. Sorry, wrong slide. Here we go. So let's say John was full-time, or an employee was full-time through here, but they went part-time in March and decided to drop benefits because they assumed they would be eligible for a subsidy or outside assistance, even though you as an employer are offering benefits until the end of December. So they drop benefits, and maybe by the time they enroll or try to enroll in the marketplace, they find out they're not eligible for a subsidy, and they try and come back and they say, oh, can we reinstate my benefits? And the time has just run out with the carrier and we can't do it for whatever reason. And the employee says, but I'm worried, I'm getting married soon, or I'm having a child. Then we say, great, as soon as you get married or have a child, that is a qualifying event for you to enroll in benefits. So if this employee chose to drop benefits in March and then say got married or had a child in August and wanted to re-enroll, they would be eligible to do that because they have a qualifying life event and they are still eligible for benefits, and there is an offer available until the end of December. So they may have a gap in coverage in that situation. It's not ideal. So this is also something to communicate to employees that the offer is still available and they should consider whether or not they are going to be eligible for certain subsidies that they may be expecting. However, they may take the time and that qualifying life event, as in dropping coverage, and maybe their spouse, or they have other coverage offers available to them where they may be able to take that drop in coverage and use that to enroll in other coverage, such as at their spouse's employer, who may have more affordable coverage for them. But yes, they do need another qualifying life event. If it is too late for them to be reinstated with the carrier, they would need another qualifying life event in order to re-enroll. And again, it's not ideal and it is complicated, and it's the IRS that we're dealing with. So they may, if they do end up going onto the marketplace and they do receive a subsidy, depending on their income, they may have to pay that back because there was an offer, and you as an employer will be documenting that there was an offer available to them. There's definitely no ideal situation for any employer or any employee, but the look back method does end up being a little bit more consistent, and it does end up being better for companies where you have lots of variable hour employees or employees with unpredictable hours. As we have seen, it can be difficult to manage. in our examples. It can be difficult and frustrating to manage if you have employees who move to part-time and end up not being eligible for subsidies, or it can be difficult just to remember that when you have an employee moving to part-time, that you need to look back on previous hours to ensure that you can have them move to part-time and draw benefits. Both methods do require tracking and monitoring hours so that when you go to report on your ACA forms, that you report accurately whether or not the employee was eligible. And again, these methods are not used for ducks. Ducks, you need to treat them as eligible as long as they are a duck. When they are not a duck, then you can use these methods. So again, if you have specific situations that come up, or you do have an employee moving to part-time and you think back on this webinar and you say, hey, there's a thing I need to do with that, please reach out to your account manager. We would love to help you with that, to look at their hours to see if they are still eligible. Also remember that you only need to offer hours to 95% or more of your eligible employees to avoid the bigger penalty. You may still face a penalty though, if they do end up receiving a subsidy if you accidentally withdraw the offer of benefits. Now let's look at when you need to offer benefits to eligible employees, because we know as employers that you don't need to offer benefits right from the start. You have a little bit of a waiting period. So in general, you need to offer benefits within 90 days to full-time employees. These are our ducks. You, of course, can offer benefits sooner. And we do recommend offering them a little bit sooner, but this waiting period can help you as an employer to have time to administer the benefits and ensure that the employee actually is working and acting like a full-time employee. But we do need to look at and remember that counting days is hard. And this is part of our vernacular as English speakers. So just as a quick short example, if today is the 5th and you have a flight in 2 days, you really don't want to miss it. What day is your flight on? It is simply on the 7th. So that's an easy to count, 5, 6, 7. But if today is the 5th and your first day of work, and assuming we're not dealing with any weekends, what day will be your third day of work? Your third day of work will also likely be the 7th. So when we are looking at eligible employees and offering benefits within 90 days after their hire date, you could also look at this and say it is by their 91st day of work. And again, or sooner. So that is when you need to offer benefits to your full-time employees, to your ducks, which also means if you are offering benefits the first of the month after a waiting period, the most your waiting period can be is 2 months or 60 days, and that needs to be coinciding with in order to make sure it is offered by their 91st day of work or within 90 days of their hire date. But again, this is only for our ducks. So for other situations, for our variable hour employees, they need to be offered coverage at the beginning of their stability period, if you are using the look back method, or when they are going to be working 130 hours in a month, if you are using the monthly measurement method. For employees who start to work full-time after working part-time, treat the day that they change class as their full-time hire date. And that is when you need to begin that waiting period that you offer for your ducks, and then offer them benefits. Employees who are rehired may have a special waiting period depending on their previous eligibility. So let's go over some of the general rehire rules. So we have this chart, and we're going to assume that this employee that was termed was eligible for benefits the day before they were termed. So if this employee who is eligible for benefits was termed for less than 4 weeks, they should be eligible for benefits the first of the month after rehire or sooner, but doing first of the month makes it easier to manage as an employer and is allowed and is considered reasonable. However, if they are termed less than 13 weeks, but more than 4 weeks, we need to look at how long they were hired and compare it to how long they were termed. So if they were eligible for benefits before they were termed and termed less than 13 weeks, if they were hired longer than they were termed, then you should treat them as a rehire and offer them benefits by the first of their month after rehire. If they were termed longer than they were hired, you can treat them as a new hire and use your standard new hire waiting period. If they were termed for more than 13 weeks, you can go straight to using your standard new hire waiting period. Keep in mind, if you are an educational institution, it is not 13 weeks that you're looking at, it's going to be 26 weeks that you're looking at. That ensures that teachers aren't consistently serving a new waiting period at the beginning of every school year, because summer is longer than 13 weeks long. So in general, these are your rehire rules that you should be following to the best of your ability. Employee Navigator is instituting some amazing changes in regards to rehires that will be available soon. We're really excited for those. But this is what you should be looking at when you are rehiring an employee and when they should be offered benefits. So again, if you have a specific situation and you remember back on this and say, the rehires have a special rules, feel free to reach out and we can guide you through based on that specific employees when they were termed, hired, and rehired. So again, we're just going to go over, remember that you only have to offer coverage to 95% of your eligible employees. We consider it good enough. You may have a penalty if one of those 5% that you don't offer coverage to goes to the marketplace and receive a subsidy. However, if you do have a penalty for an eligible employee who was not offered coverage and that employee went to the marketplace, that penalty is usually less than what the cost is to offer coverage. We will be discussing penalties further in depth in our next Tuesday's webinar. We know they're complicated and difficult because there's such a large time period between when you offer benefits, when you file with the IRS, and when the IRS finally discusses any penalties that you may have to pay. So there's a large disconnect for us as employers and employees about how the penalties apply. So penalties are something we're really excited to go over. They're something that's hard for everybody to work with, but that'll be in our next week's webinar. So if you have any final questions, please feel free to put those in the questions box. Our previous webinars will be available shortly on the blog. And this webinar has been recorded. And also please keep in mind that these are not official legal or tax advice, but we do have resources at Beehive to get you to lawyers who are licensed in your state, whether that's Utah or Idaho, Arizona, California. We have resources for that. We also have resources and partners who can give HR advice, tax advice, etc. We also have a location for our upcoming webinars. So if you have not registered for our webinar on the penalties or on how to manage the ACA in Employee Navigator, that's at our go-to stage link /channel/beehive-insurance. We're really excited for those upcoming webinars, and we hope you are able to join us. So if there are any final questions.
Yeah, so we talked about the look back method and the monthly method, and we've talked about ducks. Now, which method, like, is there a method that you use for ducks, or are the ducks just?
The ducks are just ducks. They will need to be offered benefits within that 90 days.
Okay.
So this is what you use when you have a duck, is just offer benefits within 90 days.
All right, nothing new is coming in. Thank you, everybody.